Hello there again. This is Dr. Lindsay. And what I want to do in this video is go over the short run market supply curve and the long run market supply curve in a perfectly competitive industry. So first, the short run. We will have a demand curve, downward sloping. We're going to have a supply curve that's upward sloping. And that supply curve is made up of all the firms in the industry. And they all have marginal cost curves that are upward sloping. So it's really the sum of all the marginal cost curves of all the participants in that market. And that will give us this market price, P star. And we know the total quantity produced in that market will be Q star. Now, this model is simpler if we say all firms are identical. So they all have the same marginal cost curves. So that's the short run, what happens in the short run. But in the long run, all costs are variable. So in long run, all costs are variable. And if they lose money, firms are going to exit the industry. If they make money, firms are going to be coming into the industry. So if there's a loss in the market, firms exit the industry and the price goes up. If there's profits in the industry, then firms come into the market, shifts the supply curve to the right, and the price drops. It's going to be stable when there's no profit or loss in the industry. And at that point, no firm is making any money. There's zero economic profit. So let's say that this P star here in blue is the price where there's no economic profit. And there's no incentive for firms to come into the industry or leave the industry. That will mean, I'll draw it here, that our average total cost curve in the long run would be the same as the average variable cost curve. And that will mean that this P star, let me draw this properly. This should intersect the bottom. That P star price that's determined in this market here will be right here. It will be right there at the bottom. Try to draw this right. A little difficult to do. Right there. Sort of. P star will be right there at the very bottom. I'm just going to fudge the lines here to make it be at the bottom of that average total cost curve. And that's also where it intersects the marginal cost curve. And each individual firm will produce at this quantity here, and they have no profit, zero economic profit for each firm. And that P star will go up and down depending on if there is any losses or profit in this industry, until we get to that P star where there is no economic profit at the very bottom of that average total cost curve. So what does that mean for the market supply curve? So if we look at the long run, in the long run, the market demand and the market supply curves in this industry, there's a demand curve and there's a supply curve, but the supply curve is not upward sloping like it is in the short run. The long run supply curve is horizontal at a price of P star, that price where no companies have an economic profit. So in the short run, the price will go up or down above P star, below P star. But as soon as there's a loss or a gain, that price changes. So we can say, yeah, in the short run, it could be almost anything here, but in the long run supply curve is horizontal at P star. So that even if the demand were to increase for this product, in the short run, the price is going to go up. But in the long run, the price won't go up because in the long run, no firms are making any economic profit. So in long run, no economic profit. And that means the supply curve is horizontal at this price P star, where at that price P star is at the lowest point on the average total cost curve. And where no firm is making a profit or loss.